Hello. Good morning, everyone. Can you hear me?
Yes,
Good morning,
ma'am.
ma'am. Good morning. Good morning.
Hi. Good morning. So I am Divya Chavla. By way of introduction, I work with KPMG. I'm a senior consultant. I am a chartered accountant by profession, and I'm based out of New Delhi. I've done my schooling from Mothers International School, and I also hold a BCom honors degree from University of Delhi. Before I start the session with ratios today, I'm going to have all of you introduce yourself for a few seconds so that, we can make this class more interactive and can call out each of your names instead of, just looking at the participants list. So can each of you like start with unmuting yourself and introducing yourself quickly? I'll just like take a name and then you can start like that. So we can start with Ishan Sen. Hello. Hello. Ishan, you can unmute yourself and introduce yourself. Maybe Ishan can't hear me. We can go on to Manisha and we can ask Ishan to introduce himself later. Manisha, why don't you start with introducing yourself?
Hello, am I audible?
Hello, yeah. Yeah. Hi
Yeah.
Manisha.
I'm Manisha. I'm chartered accountant, and I worked in Deloitte for 5-6 years, and then I worked in India Today Group for 2.5 years, and now I'm on sabbatical. So basically, I'm on break for 2 years now.
Okay,
So
all right. Which department were you working for in Deloitte?
I was in direct taxation department.
All right, okay, all right.
Mhm.
Great.
So yeah.
Uh, great. Okay, Piyush, can you introduce yourself now?
Hi, I just said Piyush. I am working as a finance executive in B4 Solution Private Limited. And I joined this course for an expansion in finance domain. For
All right, great, Piyush. Welcome to the session of ratios.
okay,
We
ma'am.
can Radha, you can introduce yourself. Radha, yeah. Hi, Radha.
Hi. Yeah, I'm working
Hi.
in KPMG only for last 2 years
Oh, great. Which department are you in?
in audit. Right.
Okay, all right.
Join
Rahul,
this
you can
course.
introduce.
Yeah.
Yeah. Radha, please continue. Actually, your voice is breaking a little bit. Can you speak a little loudly?
No, it's done. No issues.
No, please continue.
I just think to join this course to explore the finance area.
Okay, great.
Thank you.
Thank you. We can start with Rahul now. Rahul Prabhu.
Hi, good morning. My name is Rahul.
Hi.
I
Yeah.
am not in the finance field, working in the finance field as of right now. I am in the internet service providing ISP business as of right now.
Okay, all right. Great. We can now have who's next? We can have Richa introduce herself.
Hi, good morning, ma'am. My name is Richa. I am a company secretary by profession, but currently I'm working in a pharmaceutical company as a business manager. So now I'm like
Oh,
looking, I want to change my profile. Want to get into finance. So basically, my purpose is here is to learn finance and to have a more exposure in finance only. Yeah, that's it.
all right. Great. Okay, Shirish.
मैं Serishif from Ematicus only.
Okay. So sorry. So sorry, Damni. Shivang.
Hello.
Hi,
Hello.
Shivang. Hi,
Hi, ma'am. Good
Shivang.
morning, ma'am.
Good
Yes, yeah.
morning.
I'm from Delhi only. I have done PGDM Finance from IMT Hyderabad, and I'm also a BCom honors graduate. I'm currently working as a financial analyst in services from past 1.5 years.
Okay. All right. Great. Siddharth Lunkar.
Hi, good morning.
Hi. Good morning, Siddharth.
Siddharth, myself Siddharth. So basically, I'm BCom, and then I have completed PGDFM from Wellington Institute, and
Okay.
currently working in the Stores Limited as a system manager accounts. So I have 14 years of experience in my in accounts. So now
Okay.
doing this course for upskilling my knowledge.
All right. Great, Siddharth. Sneha.
Good morning, ma'am. I'm
Good
Sneha here.
morning.
Yeah, so
Yeah.
basically, I have around 4 years experience into investment banking. I was
Oh,
working with Deutsche Bank till December
okay.
2019. Right now, I'm on a break,
Okay.
so I have done my MBA in finance. That was
Okay.
long back. So I just joined the course, to basically
Refresh your.
yeah, exactly, refresh because that was like
Mm,
10 years back. I did my MBA, so just to
yeah,
get
of
it
course.
right. Yeah,
Of course. Great.
yeah.
Swapnil.
Yeah, hi, good morning.
Swapnil.
Uh,
Hi, good
Hello?
morning. Yeah. Hi,
Yeah,
good morning, Swapnil. Yeah.
good morning. I am a chartered accountant. I have about 5 years of experience. I've also completed my law, and currently I'm working with
Oh,
a real estate
wonderful.
company with in finance into fundraising.
All right. Okay. Great. Varun Badai.
Yeah, hi, good morning. Hi, good
Hi,
morning.
good morning. Good morning.
Yeah, I've done actually MBA Finance and I'm now working for the past 3 years in HDFC Bank as a service manager.
All right. Okay. Yogesh Kadam. Yogesh. Yogesh, can you hear me? Okay, let me ask someone else. Maybe we can ask Yogesh later. Narayan Janga. Narayan, can you all hear me? Because both of them are actually not responding.
Yes, ma'am. We
Nan.
can hear you.
Okay, Narayan. Hi. Hello. Okay, I think Narayan has got disconnected. All right. Till then, we can have Nancy Neema Mehta introduce herself.
Yeah, hi.
Hi.
Myself Nancy Nima. Yeah,
Hi.
my name is Nancy Mehta, and I am an MBA in finance. I have an experience working in the merger and market as merger and acquisition for about say 3 years with boutique firm, and post that I changed my field to more of a financial analysis technology, and now before post joining this course, I was not able to continue this course because I got an opportunity with PwC, and currently I am working with them as a senior associate in
Mhm.
and looking forward to this course. I have joined this course with an aim to have a better upskilling myself, as well as to get a better opportunity in the industry, get a better place in the
All
industry.
right, great. Great. All right, great, Nancy. Okay, Arpit, we can have Arpit introduce himself now.
Yes, good morning, ma'am.
Good morning, Arpit.
Yeah, I'm just pursuing graduation, and this is my final year, and I'm
Okay.
just looking for the job prospects.
All right. Okay, I can ask now Anamika Mehan to introduce herself. Hi, Anamika. Am I audible to you?
Yes, you are audible. Hi, ma'am. I've done MCOM.
Hi, your voice is
Voice,
okay.
can you hear
Hi,
me?
actually, your voice is little low. Can you speak a little loudly
Okay,
if possible?
okay. Is it
Yeah.
audible now?
Hi. Yeah, it's
Okay.
audible now. Hi, Anamika.
Hello, ma'am.
Yeah.
Good morning, everyone. And I have done MCOM and MBA in finance, and presently working as a senior analyst in R1 RCM, and that's all
All right.
about me.
Okay. Okay, great. Amit, you want to introduce yourself?
Hi, my name is Amit Khare. I have done PGDM in finance and I'm working in accounts payable at Barclays. And I have experience of more than 8 years in accounts payable only.
All right. All right. Okay, great. Ishan Sen, if you're here and you can hear me, why don't you introduce yourself? Hi,
Hello.
Ishan. Hi,
Hey, ma'am.
Ishan.
How are
Yeah.
you? Good
Right.
morning, all of
I'm
you.
good. How are you? Good morning.
Yeah, I'm Ishan Sen. I have done my MBA from MIT University. Currently, I'm working with Evelyn Learning System as a content manager. So, thank you.
All right. All right. Okay, great, Ishan. Welcome to the session of ratios. Have I missed out on anybody? Um, Tejas, why don't you introduce yourself?
Hi, I'm Tejas, and
Hi, Tejas.
I work with Citigroup Global Markets in the back office and data operations department in Mumbai.
All right. Okay. Welcome, Tejas. So, guys, firstly, can you see my screen? And if you can see my screen, what can you see on my screen? I'm just going to do a test run of 2-3 slides to know so that there is no time lag. What can you see on my screen?
Introduction to ratios.
Ratios.
Yeah. Okay. So now I'm changing my slides. Can you see the change also?
Yes.
Yes.
Yes,
Okay.
agenda.
So welcome guys to the ratio session. This ratio session will be divided over 4 days. I'll be taking 2 hours today as well as 2 hours tomorrow. And I think the next 2 days are, I think, on the next weekend. We are going to, I'm going to ask you guys to note down formulas on a separate sheet, even though I think you all already have this presentation. But I still want you guys to note down, all of these ratio formulas on a separate sheet so that, whenever you're revising or whenever you want to have a quick look at formulas, you have them separate on a, written separately on a different sheet. So whichever slide has formulas and you want me to go slow, just write on chat. Just write on chat and I'll go slower. If you feel there is a time lag and I'm talking about something that you can't see on the screen or something, you can always let me know through chat and I will try to ensure that you are being able to see the slide that I'm talking about. Because this is all virtual, sometimes there's a time lag in, you being able to view the slide that I'm talking about. So as I understood from each of your introductions, this is a class which is a mix of, people who have finance and accounting background and people who don't. So we're going to do start like with something very extremely basic, and then we're going to go on to higher level of ratios, only to ensure that everybody is on the same page. So just to start with, can you all just tell me, so you all can write on chat because it will be otherwise difficult to hear everybody talk at the same time. So can you all tell me a basic meaning of ratio? I'm not asking you to tell me the accounting, what the accounting terminology means, but what does the term ratio mean even to a layman? Say if you have to explain what a ratio means to your mother or to your father, how are you going to explain it? Anyone?
Um, it's a
Chat.
relationship between two variables.
All right. So
Yeah, relationship
I
between two amounts.
okay. So for instance, I have a number 4. Okay. Now tell me one thing. Does a number 4 denote anything or express anything to you? Or I say, for instance, that in an industry there are say two companies, company A and company B. Company A is making a net profit margin of say 20%. Does that denote anything on a comparative basis between those two companies? No, right? Because I am not depicting this in the form of a ratio. An absolute number does not denote anything in itself while you're making a comparative analysis. So ratios is in layman terms nothing but a quantitative relationship which is between two amounts or two numbers, which actually shows the number of times one value contained or is contained within the other. For example, I can say in an X company, the ratio of men's jobs to women's jobs is 2:1. I mean, I'm just giving an example, but you can denote one thing in the number of times or in value or in percentage to another variable, as correctly said by somebody on the group. Balancing between two things to measure something, it's a fraction, it's a division of numbers, finding something depending upon two or more factors. So guys, practically it is nothing but a quantitative relationship between two amounts showing the number of times one value contained or is contained within the other. Now, can you all tell me, I mean, why do you think accounting ratios is something which is useful at all times in your life? I mean, you may not even realize, but you're applying an accounting ratio concept in your mind while you're doing anything related to finance. I mean, you may not even realize, but you're using these concepts. Why do you think so? I mean, why do you think ratio analysis is, I mean, what are the benefits of doing ratio analysis? So while I was doing chartered accountancy, yeah.
Hello.
Yeah.
Ratio analysis basically helps you to compare two companies performing in the same industry to see where the one company is lacking, and similarly, if not within two companies, even for a single company, you can compare ratios for 2 or more years and see how much growth or some growth the company has taken in.
Yes, so basically, as correctly put by Manisha, you will be able to identify the areas in a particular entity that needs more attention with the help of ratios. Of course, ratios will be calculated depending on what ratios are relevant to that particular company. Then you will know what potential areas can that company improve on. Of course, you can do a comparative analysis of companies in the same industry. And as rightly said by Manisha, not only can you compare the performance with other companies, you can compare the performance of the same entity with its past performance to understand what is the growth, what is the performance, has the company been able to achieve cost efficiency, has the company been able to increase, meet its profit targets. Also, it helps in budgeting and forecasting. So basis my ratio analysis, I can also budget and forecast for my future years at what kind of growth, what kind of profit curve am I looking at. You can also, so of course it will depend on what kind of ratios are relevant to the particular company, but you will be typically calculating liquidity, solvency, profitability, activity ratios to understand different criterias which are applicable to that particular company. Also, you can make estimates, you can prepare plans for the future with ratio analysis. Can anybody tell me, do you know what DuPont analysis is? Do you know, I mean, what is, so in today's session, we're going to cover the following topics. Ratios includes DuPont analysis, objectives, introduction, types of ratios, which includes profitability, activity, liquidity, solvency, and valuation ratios. We'll also talk about the limitations of ratios, and we are also going to do a lot of questions and then some questions that make you do after finishing a set of ratios. Most of the questions will be taken up at the end of the session. So guys, can you tell me, have you all heard of DuPont analysis? Okay, what
Hello.
about the others? Rahul and
Yeah.
Tejas are saying no. Okay, no problem.
Uh,
What about the others?
Hello.
Yeah.
DuPont analysis is basically that we divide the company's performance in three phases, in three, like as profitability, as assets turnover, and financial leverage.
Right. So basically, DuPont does break a particular expression into three parts, which I'm going to take up in the next 5 minutes. So this actually is, DuPont was actually something which comes from DuPont Corporation that actually started using this formula in 1920s. And Donaldson Brown invented this formula in its internal efficiency report back, I think, in 1912 or something, if I'm not wrong. Before I take you through the theoretical, slide explaining DuPont analysis, I am going to ask you guys something. I'm sharing an Excel sheet. Just let me know if you can see it. Yeah. Can you see the Excel sheet? Guys?
No, ma'am. No.
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 Okay. Just then let me know if now you can see it.
Yes, ma'am.
Yes.
You can see the Excel sheet, right? Now, so one major question that I want to ask you is that why does an investor or any prudent person, why would that person invest in a particular business or in a particular company? We are going to, talk about a very important analysis tool today in financial valuation, which is DuPont analysis. And to begin with that, I'm asking you this very basic question, that why does someone invest in a business?
To earn profits.
Right. So a company may be making a lot of revenues but may not be earning enough profits. So it does not achieve the objective of the investor. Now consider these two companies, Company A and Company B. Company A has earned a profit of rupees 10 and Company B has earned a profit of rupees 20. Company A has earned a profit of rupees 10 on an investment of rupees 10, and Company B has earned a profit of rupees 20 on an investment of rupees 1000. So can any of you tell me which company is better?
Company A, because you're investing less money and getting the same amount of profit, almost the
Yes,
same.
absolutely right. So how did you do this? Do you even know that in your mind you actually did a comparative analysis? How did you calculate that Company A is doing better than Company B? Because you calculated in your mind what is known as a return to these shareholders, return on equity or return on net worth. How did you do that? You divided the profit with the amount of investment, right? So you realize that Company A is investing rupees 10 and also making a profit of rupees 10, and Company B is, even though Company B is making a higher profit, Company B is investing 1000 rupees, which is 100 times more investment than Company A. Now tell me one thing. If I would have just simply showed you this, what would you have said? You would have said Company B is doing better than Company A, right? So what you need to understand is that absolute numbers in itself are not a correct measure to understand how a company is doing. All right. So guys, DuPont analysis, under DuPont analysis, return on equity is a very closely watched number by many investors. It is actually a very strong measure to understand whether a company is, generating enough return and on how much of an investment that is made by the shareholders. But I want to tell you one thing, that what DuPont said was that it may not be prudent to only look at return on equity and judge the particular company without breaking return on equity into three components. Why? Because only by looking at return on equity, investors can actually be falsely duped into believing that a company is doing well or a company is a good investment or a company is not a good investment. So to avoid false assumptions of investors, DuPont analysis came into the picture, which broke down return on equity into three parts. The three parts that DuPont Corporation had broken down DuPont analysis into was profitability, asset use efficiency, and financial leverage. Can you all see the slide wherein I'm breaking the return on equity components? Guys, can you just see the slide of return on equity being broken down into three components?
Yes, ma'am.
All right.
Yes, ma'am.
So, guys, how to measure the profitability part of return on equity? We measure it through net profit margin. How to check whether the assets are being efficiently utilized? We check it from asset turnover ratio. And how to check the financial leverage of a particular company? We check it through equity multiplier. So what I firstly want to understand is that how did this DuPont formula get derived? I mean, what was the relationship between the balance sheet and the P&L that helped DuPont in arriving into this formula? Can you tell me one thing? How did this happen? What is the link between these measures, or what is the link between the balance sheet and P&L that these three measures came into place? Like someone rightly said, that the ultimate objective is that the company should earn profits so that the shareholders also earn profits. Can you tell me what is the link between balance sheet and P&L? So the three major links that exist between P&L and balance sheet, firstly, is that how the equity that is a part of the balance sheet gets converted to assets. How efficiently am I utilizing the funds that are invested in a particular company? I mean, no company would want to invest in the wrong machinery, in wasting assets, in assets which are not going to generate revenue in future for that particular company. Then after say purchasing those assets, are those assets generating revenue from me? How do these assets get converted into revenue? Then if the assets get converted into revenue, how is that particular amount of revenue getting converted into profit? Because there can be a company X which can have a lot of equity investment but may not utilize the equity investment in the correct manner. Or a company may utilize the investment in the correct manner, purchase the right amount of assets, have a balance in that particular company, but may not be able to generate enough revenue. Or a company may be able to generate enough amount of revenue but not enough amount of profits because of inefficient cost utilization, etc. Right? So DuPont formula, typically return on equity is nothing but net income divided by shareholders equity. Like that's what you checked here, right? Return on equity is nothing but net income divided by sorry. This is the formula of return on equity. Now I am going to break down this formula into three parts, but ultimately arrive onto this formula only. Alright, how will I do it? I will divide net income. I'll divide it by sales. I will then divide my sales with total assets. And I will divide my total assets with equity. So what were the three measures that I talked about? Can anybody tell me? So if you see that ultimately with these three formulas, you're going to arrive at net income divided by shareholders equity only. But to understand the performance of a particular company better, so that then shareholders can make a sensible judgment of that particular company, we have divided it into three aspects. First one being net profit margin ratio, asset turnover ratio, and financial leverage. Right? So ultimately, this will boil down to the same formula, which is net income divided by shareholders' equity. But in order to understand the company better, we will check all of these variables for a particular company. Can you all see it? Please write this down, guys. Guys, let me know once you've written it down. Please write, even though you may have the presentation, please write down the formulas on a separate sheet. Have you written it down, guys? Should I proceed further? Yes, please. Okay. Piyush is saying yes. All right. So, guys, now I want to understand that if a company wants to increase its return on equity, how will it do so? I mean, you have the three variables that we've spoken about. How do you think by understanding these three measures, if a company wants to improve its return on equity, how will the company do that? How can a company increase its return on equity? Yeah, is anybody answering on chat? Guys, how will a company increase its return on equity? I am displaying these three measures right in front of you. I want to ultimately, by using these three measures, increase my return on equity. How will I do that?
By increasing the net income
Right. Or you can just
or
say by increasing
profitability.
the ultimate, or you can also say that, yeah, by increasing the ultimately net profit margin. Yes. Then what more is your suggestion? Increase net income, increase sales, right? Guys, by looking at these three measures, the simplest way to understand how a company will increase its return on equity is by having a higher net profit margin, by efficiently utilizing the assets so that the company is generating more sales, and by having optimal amount of financial leverage in a particular company. We are going to come to the concept of financial leverage also. But before that, can anybody tell me what is net profit? Everybody understands basic terms of revenue, variable expenses, fixed expenses. Everybody understands, or should I take you through those terms as well? Okay, let me actually start with what is revenue. Can anybody tell me what do you mean by revenue? What is the difference between revenue and what is the difference between profit? Guys, anybody, what is the meaning of revenue? I'm starting from very basic so that you guys don't have any issues. But we need to do this a little more quickly. Income generated from core activity of organizations. All right. So Siddharth and Piyush are saying revenue is income from operations. So yes, in revenue is nothing but the amount of money or income generated from the main operations of a particular company. For example, if I am say I am a company which manufactures and sells garments. So my revenue from operations, which will include the amount that I have received from selling those garments. But if say as I have invested into certain securities and I'm receiving interest from them, that interest will not be my main revenue from operations. It will come in other income. Why? But if I am a bank and I am getting interest, that will be a part of my main revenue from operations. Do you understand the difference, what I'm trying to say? Revenue from operations is nothing but the amount of income or revenue generated for a particular company from its main business operation. सिंपल सी बात है, कंपनी जो करती है उससे जो कंपनी अर्न करती है वो कंपनी का रेवेन्यू फ्रॉम ऑपरेशन है. Alright. So if I've given you a very simple example, interest for a manufacturing company which manufactures garments and sells garments is not revenue from operation, but interest on the same at the same time is revenue from operation for a bank. Did you all understand the difference? Profit is what remains. Right. Okay. Everybody knows what are variable and fixed expenses. Can you all give me a quick example of a variable expense and what is a fixed expense? Can you all quickly tell me?
monthly rent is a fixed expense, whereas raw material expenses will be a variable expenses.
Right. So variable expenses and fixed expenses, what is the primary difference between the two? Variable expense, rightly as it is in its own terms, has the meaning vary. It varies with the level of activity. All right. Fixed cost is the cost that stays fixed, that stays put. Like somebody said, rent expense. Now, just like I give you an example of a company that is manufacturing garments. If a company has, say, 10,000 rupees of rent of a particular factory, for example, that 10,000 rupees will remain constant in spite of the fact whether the company makes 10 shirts or makes 10,000 shirts in that particular month. All right. So, how do you calculate your net profit margin is what is my next slide. Yeah. Net profit margin is nothing but net profit divided by sales into 100. And net profit is nothing but your revenue minus your variable expenses minus fixed expenses minus interest minus tax, and then you arrive at net profit. So naturally, if your net profit margin is more, your return on equity is higher. Guys, are you all aware of the terms gross profit, net profit, earning before interest and tax, earning before tax? Are you all aware of these terms?
Yes.
All right. Okay. I'm going to try and give you let me actually finish a set of ratios and then I'll go on to the examples. Okay. So my next ratio is nothing but my asset turnover ratio. As we correctly spoke, that it indicates how assets are efficiently being utilized so as to earn revenues for that particular company. It is nothing but a measure of utilization and efficiency of a particular asset. All right. For example, I would say that my asset turnover ratio is 5. Can you see how will it be 5? It means that for every 100 rupees of asset that I have, for 100 rupees of asset that I have, I am generating 500 rupees of revenue. Did everybody understand? It measures that my assets are being utilized 5 times in comparison to each rupee of asset invested in a particular company. Naturally, higher the resulting number, better the utilization and efficiency of a particular company. So both net profit and asset turnover, higher the better. Now, asset turnover ratio also can be divided into two components. Guys, are you writing anything on chat? Because I have not. Raw material is variable, rent is fixed. Fixed. Okay. All right. Yeah. So asset turnover ratio can be further divided into two things. Asset turnover ratio can be further divided into two parts. One is fixed asset turnover and one is working capital turnover. Can anybody tell me what do you mean by working capital? What is your fixed asset turnover? What is your working capital turnover? What do you mean by working capital? Are you guys writing on chat? What do you mean by working capital, guys? It has, see, whenever you're trying to understand the meaning of a term in accounting, see that does the name denote anything? Like when we talked about net profit margin, when we talked about asset turnover ratio, those things have the meaning in the term only. Working capital is required for day-to-day operations, yes. Working capital, it's not necessarily only the cash. It is actually the capital that is used in day-to-day whatever operations are of a particular company. And how is it calculated? Can anybody tell me how is working capital calculated? It is not necessarily cash, Siddharth. You will say it is the funds. I mean, it may not be like cash in hand. it means the funds that are needed to meet the day-to-day operations of a particular company, which will obviously include both current assets and current liabilities. Yes, so correctly said by everybody, it is current assets minus current liabilities. So fixed assets turnover is nothing but checking the efficiency of how my long-term assets, which are my fixed assets such as, plant, machinery, land, etc., how efficiently are those assets generating my revenue. And working capital turnover is nothing but how efficiently are the funds that I'm using on a day-to-day operation. How is my working capital? How good is my particular company in efficiently managing my working capital, my short-term capital, right? So naturally here also, higher the asset turnover ratio, higher will be the company's efficiency and higher will be the company's return on equity. Working capital turnover is nothing but receivables turnover plus inventory turnover minus payables turnover. Guys, can you all please note down all of these formulas? I hope you've noted down the net profit margin, the asset turnover, and now you're noting down the working capital turnover formula. Just note down the formula. I'll proceed to the next slide then in another 2 minutes. Have you all noted down the formula? Should I proceed to the next slide? So guys, next measure that we were talking about was the equity multiplier. Before we talk about the equity multiplier, can anybody tell me what do you mean by the term financial leverage? And can you also tell me if financial leverage is good for the company or it is bad for the company? Guys, I'm going to just pick anyone because none of you are answering. So I'm going to pick Tejas. Tejas, can you tell me what you mean by financial leverage? So guys, don't be afraid of going wrong. That is the whole purpose of this class. Can anybody tell me what you mean by financial leverage, Tejas?
Basically, I mean, if I'm generating a certain amount of profit, but if I take a small loan, that profit would increase more than proportionately. So that would be financial leverage.
But why would the profit necessarily increase if you take a loan? I mean, it may increase without a loan also, or it may also decrease with a loan.
I mean, see, if I have certain capacity to produce, say 100 items, but I'm not able to utilize that 100. I'm currently producing around 80 due to funds crunch. So what I do is maybe take a loan, any short-term loan, and say interest on that loan is 8%. But what happens is if I take a loan and invest in, say, additional machine to produce additional 20 items, my profit
So you're saying the cost of your loan is lesser than the amount of revenue that you're generating from selling those 20 items.
Yeah.
Okay, but I want to ask you one thing. That you are saying that this particular company had an unutilized capacity of 20 items. So in order to produce up till its capacity, it took a loan and hence it was generating say 1,000 rupees from those 20 items, and the loan amount that it had to pay was say 300 or 400. So those 600 was the benefit of taking that loan, right?
Yeah.
But what I want to ask is that do you think that companies who So you can probably say that this company was underutilized, but do you think that companies that are completely utilizing its potential or capacity, do you think those companies should not take loans, or do you think that those companies do not take loans? I mean, do you think that financial leverage is a concept only for those companies which are in need of the money and do not have enough investment or
No,
cannot
actually,
get investment?
I just used this as an example. I mean, yeah,
Yeah,
there
yeah.
may be many
I'm
other
just
cases.
offhand asking you that say
Huh,
I am a well-established company. See, if you say that, okay, I'm a startup, I take up a loan so as to,
right.
move forward with my operations, all of that, okay, got your point. But what if I'm a very well-established company? Will
Hmm.
you advise me to take financial leverage, or would you say that if I take financial leverage, is it bad for my company? I mean, when I have enough investment or when I can take more
No,
investment
I would
easily.
say it is not bad at least.
Exactly. So
I would say it is
financial
not bad
leverage,
actually.
yes. Why? So typically, so firstly, as correctly put by Tejas, financial leverage is nothing but using debt to, buy more assets or fully utilize the potential or expand the operations or whatever purpose that particular company has. Leverage is nothing but employing debt in my company to increase the return on equity. All right. However, obviously, an excessive amount of financial leverage may increase the risk of failure because it becomes very difficult for a company to repay debt in case the amount of leverage used in an organization is way too high. But I would never ever say that leverage is good or leverage is bad. It is neither good, it is neither bad. It completely depends on the income generation, productivity, ability of the company to, how it conducts its operations, what is the capacity of the company to be able to repay its debts, what is the standing of the company. There are multiple things which will impact whether a company should be taking a high amount of debt in that company's in that organization, or whether the company should not take debt in that organization. Of course, use of financial leverage also, gives you tax benefits, which is also one of the primary advantages of taking it. But obviously, the potential impact of leverage, it can be both positive and negative depending on the risk-taking capability of the organization. So it is nothing but use of borrowed money in an organization to whether expand its operations or to purchase assets or whatever. I mean, whatever the XYZ purpose that the company has. And the ability of taking how much leverage in an organization will completely depend on the company's capacity to repay and the growth perspectives of a particular company. All right. So financial leverage is nothing but, sorry guys, financial leverage is nothing but use of debt. Higher the amount of debt compared to total assets is higher the amount of financial leverage. It is calculated, equity multiplier is calculated as assets divided by equity. It is equal to the firm's, by comparing the total assets to total stockholders' equity. Equity multiplier will indicate whether a company finances these assets primarily through debt or equity. Higher the equity multiplier, higher is the leverage of the company, or there is more debt in comparison to the assets of a particular company. Now I have a particular question to ask you. Now you look at this company. No, one second. If I say that I have a company X and a company Y, both the companies have a return on equity of 45%. Will you be able to tell me which company is better? Can you tell me which company is doing better? Yes, Arpit. Of course, asset turnover ratio is, more primary ratio in manufacturing in all of those industries, but it is also used in IT, TCS companies such as IT and TCS as well. Now, can anybody tell me that if I have said that company X and Y both have return on equity of 45%, can you tell me which company is doing better? Guys, if you're writing on chat, both X and Y. Yes, so it is a very difficult position for you to comment on because both the companies have exactly the same amount of return on equity. Now, exactly what DuPont told you was to break down these components into profit, asset turnover, and financial leverage. So if you can say that company X and company Y, even though they both have the same amount of return on equity, which is 45%. Company X has a profit margin of 30% in comparison to company Y's profit margin of 15%. Asset turnover ratio of company X is 1 while company Y is 3. The financial leverage is 1.5 times and the company Y's financial leverage is 1. So as you can see that the companies, even though they generate ultimately the same amount of return on equity, the other aspects are completely different. So DuPont was trying to say that analyze each of the measures to understand and help the investors compare companies within the same industry. I'm assuming that in right now, company X and company Y say are in the same industry, which is the healthcare industry. All right. So proceeding further, as we've spoken about, that ratio analysis helps put financial numbers in their context by expressing one number in relation to the other. For example, I'm comparing profit margins of two companies. So I'm actually putting context in these two numbers by saying that I'm comparing the profit margin of a company X, which is in the healthcare industry, and company Y, which is in the healthcare industry. Ratios explain numerical relationship of financial variables with another variable, and they also help readers analyze the performance of a company, assets, the financial stability that the company has, and its decision making process. All right, so like we had discussed earlier, if I tell you that a company is making $100 profit on $200, that is impressive. But if I would have told you that a company is making $100 profit on $10,000, then that will not be impressive. So absolute numbers, by saying that a company is making $100 profit, this is an absolute number. This will not give you enough understanding of the company's performance. But the moment I say that the company is making $100 profit on XYZ amount of investment, you will be able to draw an analysis of the company's performance. All right, so ratio analysis is nothing but a quick indicator of a company's financial health. Obviously, different companies will use different ratios that are applicable to that particular company to evaluate the company's operations, to understand the efficiency of those operations, to understand the risk that is existent in the company's operations. Then, of course, compare the performance with other industry participants, to compare the performance with the past performance of that particular company. All right. So if you can see, I have covered nothing but the introduction to ratios, what is ratio analysis, and the objectives of ratio. So can you all tell me, I mean, who all will be the users of ratios? Ratio analysis is important to who all who are related to a particular company, or who are actually not even related to that particular company. Can anybody tell me? Who all do you think are interested in ratio analysis? Or shareholders, investors, management? Yes.
Debtors, creditors.
Potential investors, Swapnil is right, but not potential investors who may want to invest. Yes. Creditors, debtors, absolutely right. Top management, Absolutely right. Employees are interested in the amount of profit the company is making to understand if the company has scope of giving bonuses, increments, so what I'm trying to say is debtors, creditors, potential investors, existing investors, your debtors, your banks, your creditors, your general public. Yes, absolutely right. So what I'm trying to say is that even though you may not realize, but a particular ratio impacts decisions of so many users of those ratios. All right. So guys, it's 11:05. I am going to take a 5 minutes quick break, and we're going to restart at say 11:10 or 11:15. Works? Guys, please don't come later than 11:15. We'll take a quick 10 minutes break to have water. All right. Let's join back before 11:15. Is everyone back? Guys, is everyone back or should we wait for another 1 or 2 minutes? Okay, so guys, now we're going to talk about different types of ratios. Different types of ratios that we're going to do today includes, my screen is visible, right? Guys, my is visible. Guys, my screen is visible. So the different types of ratios that we are going to do today includes profitability ratios, activity ratios, liquidity ratios, and solvency ratios. Under profitability ratios, we're going to talk about margin ratios and return ratios. Under activity ratios, we're going to talk about turnover ratios. Under liquidity ratios, we're going to talk about cash management and working capital ratios. And under solvency ratios, we're going to talk about capital structure and coverage ratios. Can you all please make this table just the way it is here? Can you all write down the amount of ratios that we're going to do? Profitability. We're going to start with profitability. So you can note down profitability, and under that we're going to do margin and return ratios. So through margin ratios, we will be able to relate profits to the sales and reflect the amount of sales that is realized as profits for the particular company. So what you need to understand is that a company may be generating high amount of sales, but very, very little amount of profits. So can you all firstly tell me what are the different P&L components that you all understand? So guys, can you see my screen? Do you all understand these terms? You all know we already discussed what revenue from operations is. Can you tell me what is cost of goods sold? What do you mean by cost of goods sold? Can you all tell me what is cost of goods sold? I mean, do you think that my electricity expense is a part of cost of goods sold? Manisha, can you tell me what is my cost of goods sold? Yes, it is the direct cost relating to manufacturing. Yes, you are absolutely right. It includes actually, for instance, like we're talking about the manufacturing company which manufactures garments. So it will be the cost of the materials and the labor that is directly related to producing that particular good. So indirect expenses such as, electricity, distribution, marketing, etc., will not form part of that cost of goods sold. Why? Manisha, can you tell me why will these indirect expenses not form part of my cost of goods sold?
Otherwise, it won't give the correct picture because we are currently focusing
because cost of goods sold, after cost of goods sold, we get the gross profit. Gross profit means actual profit turning out of the manufacturing activity, and other are
Yes.
fixed.
Yes. So cost of goods sold is nothing but the actual direct cost relating to the material and labor in which is used in manufacturing, or basically which is directly attributable to manufacturing of a particular good. It does not directly relate to the production of goods. Why, Swapnil? Acha, you're saying that the indirect expenses don't relate to the production of goods. That is why they are not included in cost of goods sold. Or are you saying that the
Yes,
cost
yes.
of goods sold? Yeah, Swapnil, tell me.
No, I was talking about the indirect costs.
Okay. So my bad. Sorry. I thought you're saying that the cost of goods sold do not directly relate. All right. So everybody knows what cost of goods sold means. Then we get the gross profit. What do you mean by operating cost? Operating cost can be, what do you mean by operating cost? What have I subtracted from gross profit to reach my earning before interest, tax, depreciation, and amortization? Everybody knows EBITDA means earning before interest, taxes, depreciation, and amortization. Everybody knows this. So once you subtract depreciation and amortization, you get earning before interest and taxes, right? Sorry. The moment you subtract your interest, you get earning before taxes or profit before taxes. Correct? So under gross profit margin, we use gross profit. Under net profit margin, you use net profit. Under operating profit margin, you use operating profit. So if you can see, we're going to talk about, these were the P&L components that I was trying to explain to you. The profitability ratio that we're going to talk about today include gross profit margin, operating profit margin, and net profit margin. Can anybody tell me what is the difference? I just showed you an Excel sheet. From this only you will be able to understand. What is the difference between gross profit margin and operating margin, and what is the difference between gross profit margin and net profit margin? Can you tell me what is the difference between gross profit margin and operating profit margin, and gross profit margin and net profit margin? So basically, as we discussed, that gross profit margin calculates the percentage or the amount of sales that exceed the cost of goods sold, right, Manisha? It's basically efficient. It is a ratio which is used to understand how efficiently are the material and labor costs being utilized to manufacture and sell the products profitably. All right. So it is nothing but gross profit divided by sales. Now, what does gross profit margin indicate? Can you tell me what do you naturally under profit and return ratios, higher the ratio, the better it is? Obviously, I do not need to tell anybody that a higher gross profit margin ratio is always better than a lower gross profit margin ratio. A lower gross profit margin obviously may indicate unfavorable or higher cost of purchasing the raw materials, or higher amount of wages, etc., or any higher amount of direct cost that is being incurred, which is inefficiently producing the sales. So, what does a gross profit margin indicate? It basically measures the manufacturing and distribution efficiency during the production process of a particular company. Direct cost and how efficiently it is using raw material, yes. No, Rahul, how much sale is converted into earnings is not measured by gross profit margin. Production efficiency, yes, Manisha. So actually, I'll answer your question, Rahul. Gross profit margin ratio only covers the gross profit. It will only show the amount of margin that the company or the business has left over after deducting the direct costs of production. So there are thousands of expenses such as, employee salaries, electricity expenses, rental expenses, marketing expenses, tax expenses, which are not included in gross profit at all. So there may be a scenario where a company may be earning very high amount of gross profit, but very low amount of net profit. So gross profit margin ratio only covers the gross profit. I'm going to ask you guys to solve a question for me. If, say, my total sales are 10 lakhs, my cost of goods sold is 3.5 lakhs, my rent is 1 lakh. What is my gross profit? And what is my gross profit margin? Can you all please send me? Please don't write the answer immediately. Okay, somebody is already written. Okay, no problem. Guys, I'm just giving everybody else another minute. This should not take so long because it's really very easy. Okay, I'm not gonna ask Manisha. She's been answering a lot. I'm gonna ask someone else to answer my question. Richa. Richa, can you tell me what is my gross profit and what is my gross profit margin? Richa, can you tell me what is the gross profit and what is the gross profit margin? Richa, maybe I don't know if she's there. Let me then ask someone else. Nancy, can you tell me what is the gross profit and what is the gross profit margin?
Can you just stay on the question so that I can see?
So sorry.
I didn't see
Yeah,
the
so sorry.
expenses,
So sorry.
so therefore.
Yeah, so sorry. So sorry. Actually, I keep looking at the chat so that I don't miss any of your messages.
Yeah, no, not.
Can you all tell me what is the gross profit and what is the gross profit margin?
It's 0.64. But it's 64%.
Okay. So Richa is saying it is 0.64. Okay. Sorry, Nancy is saying it's 0.64. Now let me ask someone else. Radha, can you tell me what is the gross profit margin? What is the gross profit?
Gross profit is 6.5 lakhs.
Yes.
And the gross profit margin will be like 65%.
Right. So, how is it 65% and how is it 6,50,000? So, Nancy, I think you have taken 10,000 of utilities also in the gross profit margin. How you calculate your gross profit is nothing but 10 lakhs minus your 3.5 lakhs, which is your cost of goods sold. You will not subtract these expenses from your gross profit because they do not directly relate to producing that particular good. So this will be 6.5
Yeah.
lakh, and when you divide 6.5 divided by 10 lakh, you will get 0.65. All right. So you
Divya,
will
but
not include.
this, yeah.
Yeah. Tell me.
The utilities basically is considered to be direct, and if it would be an electricity, then it would be an indirect expense. Therefore, I've taken 10,000 as the direct expense. Utilities could be the factory in the production in the machine while we are running the machine in
So
the
I'll
production of
also
goods.
I'll clarify
Yeah.
two things. So I'll
Therefore, I
clarify two things. No, no. So Nancy, I'll clarify firstly two things for you. Firstly,
okay.
if here I was given, say, direct, or I would say purchase of raw material, 20,000. Can anybody tell me, would you also subtract 20,000 here? I'll clarify two things for you. Chat.
Yes,
You would subtract it.
yes.
All right. Anybody else? So my answer is no, guys. I'll tell you firstly the reason why. Because I already have cost of goods sold, which is given here. Cost of goods
Included.
sold is nothing but opening stock plus purchases plus any of my other direct expenses minus closing stock, which means that this 20,000 has already, the effect of 20,000 has already been taken in this 3.5 lakhs. So I will not include this 20,000 here. Now, for example, this cost of goods sold was not given here. It was, say, opening stock. Then you would do 3.5 lakhs plus 20,000 and then you would subtract the 3.7 lakhs from your sales. But here, because you were already given the cost of goods sold, you will not subtract this 20,000. So my first answer to your question, Nancy, is that if you would have even assumed that this utility is some direct utility expense, even then you would not subtract this 10,000 because the effect, when you are directly given 10 cost of goods sold, it means the impact has been taken. So I'll give you
Okay.
another example firstly. See, if I have credit sales, 6 lakhs. Now, when you are dividing the gross profit with the total sales, you will divide it by 10 lakhs, right? You will not divide it by 10 plus 4 plus 6. You will not do it, right? Why will you not do it? Because you're already given the total sales value. So which means that these two have been already included in the total sales. So likewise, under cost of goods sold, firstly, even if you assume that this utility is a direct utility expense, you would still not subtract it. And secondly, Nancy, utility expenses generally not assumed to be a direct utility expense. If anything was a direct cost, it would directly be mentioned here. Utility expenses
Okay.
are generally assumed not to be subtracted from gross profit. All right.
Okay. Yeah.
Okay. So I'm proceeding to the next part now, which is the operating profit margin ratio. Now, can anybody tell me, after we have discussed the gross profit, what do you mean by operating profit margin ratio? I mean, what do you think? Are we subtracting from operating profit that we are not subtracting from gross profit to arrive at operating profit margin ratio?
Operating expenses.
Sorry, I couldn't hear you. Who was that? Sorry, I
Operating
couldn't hear you. Can you
expenses.
repeat? Operating
We'll have to
expenses,
separate.
right? right? So basically, operating profit margin ratio is nothing but it shows the amount of revenue which is made up by the operating income. It is actually nothing but a ratio which demonstrates kitna revenue bacha hai after subtracting all the variable and operating costs. And so what I want to tell you is that, you know, projects which vary widely in size, operating margin can still be used to investigate a particular project or compare multiple projects within a particular company. But generally, net profit margin is the profit margin that is preferred to compare the profitability of the companies. However, because the thing is that operating profit margin only gives you a picture of your company's profitability rather than drilling it down into specific costs. All right. So two companies can have the same operating profit margin but can be vastly overpaying for goods. One can be vastly overpaying for goods and the other can be vastly overpaying for labor. So according to me, operating profit margin is not a very good indicator. However, yes, we would still study this ratio, but in accordance to me, net profit margin ratio is any day a better indicator of the company's profitability. Now I'm going to ask you guys to do another question. Let me just convert this only into the operating profit margin ratio. Now see, this is can you all calculate the operating profit margin ratio from this? Can anyone tell me what is the randomly pick anybody to answer? Shivang Gupta, why don't you answer what is the operating profit and what is the operating profit margin ratio?
Operating profit is the 3.6.
And what is the operating profit margin ratio? I can't hear you, Shivang. Can you speak a little loudly? Or
36%.
can you just 36%? Anybody else? Siddharth, why don't you answer what is the what is the operating profit ratio and what is the uh, operating profit? Siddharth? Anamika, why don't you tell me what is the operating profit and what is the operating profit margin ratio? Namika is also not there. Let me ask Meenal. Can you tell me what is the operating profit and what is the operating profit
Uh,
margin ratio?
I got the same answer,
Okay,
3.6 and
great. So
36%.
everybody has
Yeah.
subtracted 10 lakhs minus 5 lakhs minus 15,000 minus 1 lakh minus 25,000, which is 3.6 lakhs, and divided it by 10 lakhs. In the same question, if you have to calculate the gross profit margin ratio, what will it be?
Is it 50%?
Right. Everybody's on the same page? Right. Okay. So basically, guys, one thing I want to tell you is that, say, according to this way, wherein we said that the operating profit margin ratio was 36%, which is basically nothing but 0.36. It means that 0.64 cents of every rupee of sales is used to pay the operating costs, which means that only 0.36 is now left to cover for our non-operating or fixed cost expenses or any other expenses which will further be covered in the net profit margin ratio. Understood? Guys, am I clear? We are going to talk about nothing
Yes.
but the net profit margin ratio now, which obviously is nothing but a ratio of after-tax profits to net sales, which we already spoke about. It is nothing but profit after tax divided by sales into 100. It covers all the remaining costs such as administration, financing, but any costs that have not been deducted up till now from the above two ratios. It is nothing but net profit divided by sales. It measures the overall profitability and it is very, very useful. It is a very useful ratio. Um, if you want to compare the results of your business with competitors, it is a very good indicator. Of course, higher the ratio, better the profitability of needless to say. So I have another question for you. If my net profit is $40,000. My total sales are $20,000 and my sales returns are $20,000. Can you tell me what is the net profit ratio and what is the net sales? Can anyone tell me what is the net sales and net profit ratio?
Net sales is 5 lakh
Net sales is 5 lakhs.
and net sales divided by net profit.
What is the ratio? Anisha is saying 8%, Piyush is saying 8%, Rahul, Amit, everybody is saying, okay, great. So everybody has done the same thing. They have subtracted sales return from sales. Now I want to ask you something. If I to net sales, does that change my answer? Can anybody tell me, does this impact? Okay, Piyush is saying no. Anybody else? I'm gonna randomly pick someone. Sneha, can you tell me, does this impact my ratio?
No, it doesn't.
So guys, I disagree. Earlier, I had said this is total sales, wherein I was saying that net sales is nothing but total sales minus sales return. Now, when I'm already putting this as net sales, I need not subtract 20,000 from 5,20,000. Now my net profit ratio will be $40,000 divided by $5,20,000 into 100. Is there any confusion? So guys, actually, these are very minor things, like I also pointed out in cost of goods sold when you're talking about that utility expense, and when I pointed out this net sales, these are very small things, but they can completely change the numbers for an organization. So please keep this in mind when you are calculating ratios. Net sales means that sales return has already been subtracted. Net purchases means purchase return has already been subtracted from the purchases. All right, now I have another example for you guys. Can you all calculate the gross profit ratio for me? One minute. Can you all calculate the gross profit ratio?
Is it 21%?
Okay, who's saying that? Just one second. Who answered 21%?
Meenal.
Manisha? Meenal. Okay.
Meenal.
Someone.
Yeah.
Okay. I'm just writing it down. I'm gonna
Okay.
discuss this once everybody is done with it.
Yeah, sure.
Is everybody done with it? So more than actually the percentage, I want to firstly understand how you guys have done it. So I'm gonna ask someone from here, which is Ishan. Can you help me understand how do you calculate the gross profit margin here?
Ma'am, I'm working on it actually.
Okay, no problem. Take your time. Okay, guys, should we discuss it now? So firstly, what is the total revenue from operations? It is 75,000 plus 25,000. So that is 1 lakh, right? What is your net purchases? It is nothing but 60,000 plus 15,000. Now, is my return outwards a purchase return or a sales return? Can anyone tell me?
Purchase of
Purchase return.
Yes,
Change
because it is
return.
a return
Purchase.
outwards. Purchases is something that is coming inside, like I'm purchasing. So just like we say debit what comes in, I purchased raw material, I got the raw material, but return outwards is that I'm returning the purchases outwards. All right, so this is 2,000. So this should be 73,000, right? What is your cost of goods sold? Cost of goods sold is nothing but your purchases plus your direct expenses, which is your carriage inwards, plus your wages, which is your 5,000. So what is this? This is 80,000, right? Guys, I have also actually not solved this question. I'm solving it with you guys. So your gross profit is nothing but 1 lakh minus 80,000, which is 20,000, and you divide 20,000 divided by 1 lakh into 100, which is 20%. Right, Manisha is right. Guys, where did you go wrong? Rahul, Radha, Richa, Piyush, anybody? I mean, if you guys have any query, please ask me. Your revenue from operations is 1 lakh, nothing but the sum of these two. Your purchases is the sum of these two minus return outward, which is 73,000. Your cost of goods sold is nothing but your purchases plus your carriage inwards plus your direct wages, which is nothing but 80,000. So revenue, so your gross profit is 20,000, which is 1 lakh minus 80,000 divided by 1 lakh into 100 is your gross profit ratio. Am I clear, everyone? Okay. So guys, this leads us to the end of today's session. I'm gonna do a lot of more slides tomorrow with you. I want to understand one thing, that was I helpful enough for you to understand minor concepts, or do you guys feel that there is some sort of improvement that I should make, which I will keep in mind for tomorrow's session? Please give me your input so that tomorrow I can make the session much better than what it was today. Or are you guys satisfied?
There is a
Ma'am,
query. Can I ask right now?
Yeah, please ask.
Actually, we were talking about operating profit and then net profit. So, what are the expenses which actually make difference? Like selling and distribution expenses are subtracted out of the operating
So
profits,
selling
and
and distribution is an operating expense, right? So again, when we talk about operating, so the term operating means anything related to your operations, whether it is revenue from operations or it is operating cost. Both the things mean that it is related to your operations, right? So it covers all your selling distribution expense is also an operating expense, because you're doing that marketing or distribution or whatever to sell your particular good that you're manufacturing or trading or whatever, right? So all your
okay.
non-operating expenses, like your interest expenses, your tax expenses, something basically which is not regular in nature. I mean, which is not related to your operation. See, I am paying tax. Of course, I am supposed to pay tax, okay, but it is not
Yes,
my
yes.
operating expense, right?
Operating, yes.
If tomorrow I get a tax exemption, my operations will
Mhm.
not get impacted. My profit will get impacted, as in my net profit will increase if I get a tax exemption, but nothing will change in my operations, right? Or if I
Okay.
supposing do not pay interest, okay, or I have some sort of moratorium wherein I don't have to pay interest. So that will increase my net profit, but that will not, because my interest expense will become zero, but that will not impact my operating cost, na? Because
Yes.
interest is not my operating cost. Got it?
Okay. Yeah, yeah. Thank you.
Okay.
Thank you.
So guys, I'm going to ask you to give me a quick feedback on a scale of 1 to 7, wherein 7 you say that the session was good. I mean, if you feel, or you can rate it on chat only between 1 to 5, 5 being the highest and 1 being the lowest with respect to your satisfaction level. 5 is the highest rating. I'm going to try and make this much more interactive than what it was even today. Now we've got to know each other a little more. So I'm hoping tomorrow's will be even better than this. Thank you so much, everyone. Tomorrow, let's again connect at 10 a.m. sharp, and we'll proceed further. We'll also try to do a lot of questions so that you understand these small minor concepts which ultimately go wrong with the way we understood it.
ma'am,
Yes.
how do you calculate gross profit ratio last one?
Gross profit or net profit? Last one we did net profit. You're asking in the question.
Yes.
Okay. So gross profit, what is the formula of gross profit ratio? It is nothing but gross profit divided by sales into 100. Sales is both my cash sales and credit sales. So what did I do? My sales were 75,000 plus 25,000. This plus this, which is 1 lakh.
Yes.
What is my gross profit? Gross profit is nothing but sales minus cost of goods sold. Cost of goods sold
Yes.
is nothing but opening stock plus purchases plus my direct cost relating to production minus closing stock. So here we don't have any information about stock. So what we did was we took the total purchases, which is 75,000, and we subtracted the purchase return. So we got the net purchases, which is 73,000. Then we added carriage inwards, which is a direct expense relating to production. And we added direct wages, which is 5,000. So this is 80,000. So gross profit is 1 lakh minus 80,000, that is 20,000. And we divided it by 1 lakh into 100. So it gave us 20%. Any more confusion?
No, ma'am. Thank you.
Okay. Varun Bedai, yellow highlighted. Can you please share? Okay, I'm writing it on message. Can you all see it?
Yes, yes.
Great. Okay, guys. So see you tomorrow, sharp at 10. All right. Bye, guys. Bye, everyone.
Thank you, ma'am.
Thank you. Bye, bye.
Thank you.
Damini, I'm leaving the meeting. All right.
Thank you so much, Divya.
Thanks, Damini. Bye.